So, Jim, you think this market right now underestimating perhaps the economic impact that the coronavirus could have? How are you kind of gaming this one out as you look at the landscape right now?
A combination of a couple of things. One, we have constantly underestimated the growth of the virus. People have a very difficult time understanding exponential growth, which is what a virus does. Also, the data out of China is very suspect as well, too. It might be measuring just the capacity of the medical system to measure it. And what we've seen, the response out of China has been to basically try and disconnect it somewhat from the global supply chain. And as that grows, I think we're greatly underestimating the economic impact that that's going to have and the lasting economic impact that that's going to have as well, too.
I mean, so speaking of that economic impact in China, I mean, you're talking about a country that constitutes 20% of global GDP, and basically like large swaths of that country are not working today, the first day back from the Lunar New Year vacation. So are you looking at, 50 basis points of GDP there, 150 basis points? What's sort of your ballpark? Where are you starting?
Yeah, you're right. It's so big right now that 20%, their crude oil consumption, which is 15 million barrels a day, is down 20% just the last couple of weeks. That's an extra 3 million barrels a day on the world market that's not being used. That's a glut. That's going to plunge the price of crude oil. To your question, last week, the Chinese government themselves said that there would be 1.5% of their GDP, and Goldman estimated 0.4 of our GDP. The virus doubled and then doubled again since that forecast came out. Tonight, we should get another updated forecast from the Chinese government. If it goes under 4%, and they're already at 4%, 4.5%, that's going to be the lowest GDP ever recorded in China. The lowest right now is 4.2, the same quarter as Tiananmen Square in 1989. So this is very serious for the Chinese economy. And this is not going to, don't confuse this with like a snowstorm. Well, everybody will stay at home for a couple of weeks, the virus will go away, and then they'll all go back to work. Wuhan has been shut down now for over 2 weeks, and there's no sign at all that this thing is abating. And that's what I'm very afraid of, is that as it grows, this is going to just be shut down more and more of the country, not to mention other countries. The country outside China with the largest infestation is Japan right now. And if it starts to grow in Japan over the next couple of weeks, could we be talking about the same thing with Japan as well, too? So this is a very serious thing that I think investors are not appreciating right now. They're hoping for the magic red headline that comes out and says, we found a vaccination, found a cure, it's mutated into something less. Right. The quarantine is working, it's all going away. That's wishful thinking. I hate to say it.
So if we're not appreciating it, is part of that, aside from maybe some wishful thinking out there, that we're in earnings season? We've had some okay deliveries. ISM numbers better than expected this morning. Is the U.S. economy, what you're talking about with the Chinese economy, but is the U.S. economy strong enough that, this is more of a blip?
That's a good question. As far as the U.S. economy goes, if you X out this whole virus thing, a couple of earnings numbers have been better than expected. Guess what? We're almost back to zero right now on earnings growth. That's not good. That's not going to cut it. Wall Street is hoping that earnings growth at the end of this year will be more like 14% as well. ISM made it back to 50 right now. And that's kind of a curious number because the Chicago ISM, one of the larger components, went exactly in the opposite direction just on Friday as well, too. Mm-hmm. That's an okay number. So if you were to ask me, where was the U.S. economy before this? It was muddling along with poor earnings on the hope that things were going to get better this summer. And if it doesn't get better this summer, I always thought that the markets were going to run into trouble. And this just underscores the idea, this coronavirus, that maybe we don't get as better this summer as everybody had hoped. And we are starting to see that with the way markets are trading.
Mm-hmm. Jim, just want to ask you quickly about where the Fed fits in here. Obviously, Jay Powell last Wednesday said they're monitoring the situation. You look at the bond market, as we've discussed before, the bond market is telling the Fed they need to cut at least one or two more times. Does this coronavirus maybe change or make the Fed more aggressive in thinking about rate cuts later this year? And what do you think the Fed ends up doing, both with the virus and also with what they're hearing very clearly from the bond market right now?
The Fed will do what they do best and what they're very good at, and that is being too late and being too slow as far as where they're going to go. They're going to look at the virus and they're going to conclude that there's nothing for them to do until the data, or if I should say, the data turns marketably worse. Then they'll react to it, and then it'll be too late as well. The inverted yield curve, 10-year yields below the 3-month yield curve, if it persists for a couple of weeks or a month, I've always argued that that's a sign that the market is telling the Fed that they should be cutting rates. Fed won't look at it that way. They'll wait for economic data to show them that it's slowed, and when they get that data, they'll be too late.
All right, Jim Bianco, President and CEO at Bianco Research. Thanks so much for stopping by.
Thank you.